Okay, hope you had a little break. We're ready to start back in with determining if an individual can claim their dependents, and if so or not, what filing status should they be using. So we're ready for part D, this example where we have the taxpayer has a live-in boyfriend, and the taxpayer, she supports 100% of him. He only earns $2,000 in gross income. The boyfriend also has a son, which is not hers, but the boyfriend's son does live then with both of them. Boyfriend files a tax return, doesn't claim himself, and he only did a tax return to get a refund and does not claim the child. He's hoping that his girlfriend can claim the child as well as himself. Is this allowed? So what would her filing status be, and how many dependents could this girlfriend claim? Can she claim the boyfriend and or the son? So look back through the notes and let's see if you can get that right. Hit pause and then we'll continue. So with this one, the taxpayer can claim in this instance both her boyfriend and the boyfriend's son, because A, she can claim the boyfriend as a qualifying relative. Remember, you do not have to be a relative as long as you lived with the individual, they supported you over 50%, and you met the income requirements, and he's below $4,050. The girlfriend can claim the son as well, because remember, no one can claim a qualifying child unless, remember the exception, unless the parent does not have to file or only files for a refund. And that's what happened here with the boyfriend. However, you might think, well, since she gets to claim the two individuals, she would then be able to claim head of household, but that is not correct. She has to claim single because head of household is much more strict, and they have to be a relative in order to claim head of household. Go back up through the notes and kind of review those two areas about claiming someone else as a relative, claiming their son, and then single and head of household rules. All right, let's look at E. Taxpayer provides 60% of support for the boyfriend who has $20,000 income. So this one's almost exactly the same as above, except the boyfriend now makes quite a bit more. And the boyfriend's son, who both live with the girlfriend. The boyfriend files a tax return but does not claim his son because he wants the taxpayer, the girlfriend, to claim him for a bigger refund. Can the taxpayer claim anyone in this case? Well, first off, we know that the boyfriend's going to have to file. As somebody who is single, that he's well over that threshold to have to file. So now think about, can the taxpayer claim the boyfriend's son? And if on this one, the boyfriend's son is a qualifying child of the boyfriend, so therefore no one else can claim him unless the exception is made, and in this case the exception is not made because the boyfriend does have to file. He meets the filing requirements for someone who is single, so he would have to file, even if he even meets the requirements for head of household. So therefore the taxpayer cannot claim either the boyfriend or the son because of the qualifying child. The girlfriend also then has to claim single once again. Part F, the taxpayer, a dad, provides 80% support for a 20-year-old son who earns $5,000 and lives with the taxpayer, and the individual attends college part-time. So can the dad claim his son, and what filing status would they do? So go ahead and if you need to, hit pause. We'll look at the answers here in just a second. For this one, the taxpayer providing over 80% is a good start. However, the age becomes a factor. They are definitely 19 or over. And if you are over 19, but at least only up to 23, as long as you're in college full-time for one semester, you can be claimed as a dependent no matter what. However, this person's only part-time. So if they are part-time, that takes them down to a qualifying relative. And as a qualifying relative, you can only earn $4,050 for the tax year of 2016. So therefore, the dad would not be able to claim his son. Therefore, he cannot claim head of household either. If you can't claim the dependent, most of the time, except in divorce situations, you can't claim head of household then either. Okay, G. 3 generations live together, just like in my example from earlier when we had it in the notes. Grandma, mom, and daughter. Grandma has a slightly higher AGI than mom. Both work, both must file tax returns. They're definitely over the limit. They both help in supporting the child equally, so 50-50. And they live all in grandmother's house. Grandma wants to claim the child. How will both the taxpayer and the grandma file? So take a second and then we'll start back up. So for the mom's example here with the grandma mom, how this is going to work out is the grandma can take the child because remember, as the parent would have to take it unless the grandma has a higher AGI, and in this case, she does. So the grandma will be able to claim head of household because she does pay for the upkeep of the house, and she does have a higher AGI. So if the only thing that changes here with the part 2 is the mom AGI is higher than the grandma, in that case, as we see here, the grandma would not claim because mom would have to claim. And the only unfortunate thing here is no one would get to claim head of household because A, mom doesn't pay for the house, and B, grandma doesn't have a dependent to be able to claim. All right, let's look at, well, we got one more left here. John and Alice live together, so this is people who have never been married. They provide over half the support of their kid. They decide Alice will claim the daughter and file single, while John will claim head of household. So they're wanting to both get a little bit of a benefit with the head of household getting a higher standard deduction, and with claiming the kid getting the extra exemption and possibly the child tax credit and anything else that goes along with that. So think about this for a second, and then we'll continue. So with this one, you can't do what they're trying to propose. If Alice does end up claiming the kid, either one of them could claim it, but if they both provide over half support, they live together, but they're not married, only one of them, though, could claim head of household, and that's the one who claims the child. So in this case, if Alice claims the child, then she needs to be the one to claim head of household as well. Otherwise, they're just missing out. If there are other examples, if you go into the IRS VITA website, again, I have that link in the syllabus area where it says text resources. Go into the VITA website, look up dependency, the dependency option. You can go through, there's different scenarios that they provide, I think are really good examples. One of the key things to take away here, if you are claimed, and then I have in big letters here, or can be claimed, even if your parents agree not to claim you, you cannot claim yourself on your own return. So that's a big one to remember. If your parents claim you, or they can claim you because you live there, they provide over half your support, you are not supposed to claim yourself. You definitely can't. The IRS won't let you if your parents claim you and then you try to claim your own exemption. It'll get flagged and you'll get rejected. Whoever is the second one to file will get rejected because the same Social Security number can't show up twice. So I wanted to recap then, well, if I have a dependent, what are some of the good things that come along with that? The first one is you can claim head of household. Again, as long as it's a family member. And head of household means you get a larger standard deduction. If you get a larger standard deduction, that means less income to pay tax on. If you have a dependent and it's a child, you can get the child tax credit, which is up to $1,000 per kid. So that's a good thing. Dependent care credit. This one is not quite so good. You only get up to between 40 and 20%, depending on your income level. Anybody over about $40,000 of adjusted gross income can only take 20%. So what that's saying is if you pay $1,000, you get to take $200 off your tax bill. So it's not terrible, but it's not like taking $1,000 off. Earned income credit, that's the biggie. That's the one that where a lot of people who are low income get a lot of money back. We'll talk a lot more about that come in week 7. Let's come down here to the standard deductions. I wanted to talk about this for just a minute to kind of give you an idea of how much of a difference you get from between single and say married filing joint or head of household. So remember the standard deduction, you use one or the other. You use standard or itemized deduction, not both. We're going to talk a lot about itemized deductions come week 6. The bad thing is about itemized deductions, you have to have quite a bit of it to even make it worthwhile. Otherwise, the standard deduction is your better option, and then you just lose any of the items that are considered itemized deductions, like charity, for example. If you don't use charity because you don't quite have enough, then you don't get to take anything. So here are the numbers for 2016. Single, I wanted you to see the comparison between single and head of household, so a $3,000 difference. Just by being able to claim head of household, you get to take an extra $3,000 off of your income. So if you're in the 10% bracket, taking $3,000 off is going to save you $300. If you're in the 25% bracket, then it's going to save you quite a bit more. $3,000 at 25% would be just under $1,000 saving on your taxes. So it just depends on the bracket on how useful that might be. The other item about standard deductions is you can have what's called an additional standard deduction, but the key here is it's only for yourself or your spouse. Any other kids who may meet the qualifications or any other people you have it as a dependent who may meet the qualifications, doesn't matter. You can only claim it for you or your spouse. Now remember, one of the items on the 1040EZ is you can't use the 1040EZ if you're 65 or older. And the reason is people who are 65 or older qualify for this additional standard deduction. So so 65 and older, or the same thing as saying greater than 64 years old. The other piece of that is you're blind. Now, why do they not put in deaf people? I don't know. Blind and 64 and older. If you are single and you meet either one of those requirements, you get $1,500, $1,550. And if you are both, very unfortunate, but if you are blind and older, you can take that time 2 times. If you are married filing joint, for each spouse that is over 64 gets to claim an additional $1,250. And then for any spouse that's blind as well, gets another $1,250. And I just kind of recapped that here. If you're both over 64 and blind, you get to take 2 of those amounts. Now, one of the, we're getting towards the end here. One additional item about the standard deduction. The standard deduction is for people who claim themselves. But if you are a dependent, but still have to file your own tax return because you earn money. Just because you earn money and are dependent doesn't mean your parents can then claim your income. They wouldn't really even they shouldn't want to, because it's going to make them into a potentially higher tax bracket. So if you're a dependent and you have earned income, you have to file your own return. However, your standard deduction may be limited. So let's look at the rule here. For a limited standard deduction, it's limited to the greater, so you get at least $1,050, or you can take your earned income plus $350 to get a standard deduction. But then note here, your standard deduction can't go above what it would normally be for a single person. So what that's saying is, if you have income of, let's see, of earned income, because that's the key word here. Just because you may have other income that's, say, bond interest, not bond interest, but some kind of interest that's taxable, or maybe you have dividend income that's coming in, that would be unearned income, and that doesn't count towards this. So that would be the only way that it might hurt you, is if you have some kind of income that's unearned. Let's look at these examples here. It's kind of too complicated to get into any specifics at this point. If I had a dependent child's total income is $2,500 of it's earned. So they have like $1,500 of dividend income that's taxable. How much would their standard deduction be? Well, you get the greater of $1,050, or the earned income plus $350. Well, the earned income plus $350 is only $850. So this individual, even though they have an income of $2,000, would be able to take $1,000.50 as a standard deduction, not the full $6,300 to get them down to then zero. You can't go below zero when you're taking deductions. The other example here, you have a dependent child whose income is $12,000, all of it's earned. So you can take the greater of $1,050 plus the earned income plus $350, but it can't exceed $6,300. So when you go through all that, well, this person would just get the normal $6,300 standard deduction. So here's the first example, $1,050, the greater of, and then example J, they get the regular standard deduction because they can't exceed it. The basic rules of, instead of always having to go back to that guide in the spiral pages that I have shown you, if you want to know who must file a return, simply look at what is the taxable income that you have, and is it greater than your exemption plus your standard deduction. And I need to change this. This is actually supposed to be gross income, not taxable, because taxable income actually comes after these, after you already take these out. So your exemption is usually for a single person, $4,000, at least this year it's $4,050. Your standard deduction that we just looked at was $6,300. So that's why on the sheet that I pulled up about the IRS spiral pages, it says you don't have to file if your income is below $10,350. This is where they got the $10,350. If you have your own business and you have net income of at least $400, you need to file. And then here's the rules if you are a dependent, if you need to file. I think we'll leave off the lecture here. I'll mention one other thing. Whenever you have a penalty, it's best not to even fill that in and let the IRS tell you what the penalty is. There's no reason to put yourself into a penalty if the IRS wasn't even going to charge you one anyway. So let the IRS bill you if there's ever a penalty. But the general rule of thumb is, if you end up owing at least $1,000 on your return, there's a chance that you will be stuck with a penalty. Now, there is an exception to that. If you owe over $1,000, but you paid at least 100% of last year's taxes. So for example, if last year you had a tax liability of $3,000 and you did pay in this year at $3,000, but you made a lot more money in other places that you didn't know was going to happen, so you end up really owing $5,000 instead of just the $3,000 that you thought, then the IRS will give you a break and say you don't owe a penalty that year, but then the next year you'll be online to take a penalty, perhaps. That's the main reason why, if you owe over $1,000, that you may not owe a penalty. But again, I wouldn't even put it on. Let the IRS bill you. With that, you'll need to, if you haven't already, look at the answers or the questions for the video quiz for this week 2. This is the only video that I do require. And hopefully you'll continue to watch. Hopefully that you find some kind of benefit out of this, especially as we get into additional chapters that get more complex.